Here is the problem with every rent versus buy debate you have ever watched on the internet. The real estate influencer side leads with the ending. They show you what a house is worth after 30 years. They tell you that renting is throwing money away, and they call it proof. The finance bro side leads with the stock market. They tell you that a house is a terrible investment, that mobility is freedom, and they pretend that renting forever has no long-term consequences. Neither side runs the full math. Neither side includes everything. This video includes everything. The mortgage interest that gets buried in year one, the closing costs that nobody mentions until you are sitting at the table, the property taxes that grow as your home appreciates, the maintenance budget that never appears on a real estate thumbnail, and the absolute biggest variable that almost never gets calculated, human behavior. By the end of this video, you will know exactly which situation makes buying the clear winner and exactly when renting is the mathematically smarter play. Let's run the real numbers. Meet Sarah and David. They are both 30 years old. They both earn $85,000 a year, and they both have exactly $60,000 saved up in the bank. They live in the same mid-sized city. A comfortable 3-bedroom home in a decent neighborhood is listed at $300,000. Sarah decides to buy it. She takes her $60,000 and puts down exactly 20% to avoid private mortgage insurance. She takes out a 30-year loan at a 6.5% interest rate. Her principal and interest payment comes to $1,516 per month. She adds property taxes of $300, homeowner's insurance of $100, and budgets $250 a month for maintenance. Her total monthly cost to own this home is $2,166. David decides to rent. He signs a lease for a nearly identical 3-bedroom home down the street for $1,700 a month. He takes the $60,000 he didn't spend on a down payment and puts it into an S&P 500 index fund. He also takes the $466 difference between his rent and Sarah's mortgage, and he automatically invests that into the market every single month. On paper, David looks like a genius. He is living in the exact same style of house for almost $500 less per month, and his money is working for him in the stock market. But let's look at what happens on day one. The moment Sarah signs her closing documents, she is not ahead. She is behind. Closing costs on a $300,000 home usually run between 2% and 5% of the purchase price. Lender fees, title insurance, appraisals. Sarah paid $60,000 to get into this home, but her real out-of-pocket cost is closer to $70,000. That $10,000 gap is an immediate loss that she has to recover before buying even starts to make sense. But it gets worse. Real estate agents love to talk about building equity from day one. What they don't tell you is how an amortization schedule works. In year one of a 30-year mortgage at 6.5%, the vast majority of your payment is just going to the bank as interest. Out of her $1,516 payment, roughly $1,300 is pure interest. Only $216 is actually paying down the loan. When you add up the interest, the property taxes, the insurance, and the maintenance, Sarah is spending $1,950 a month on costs that build absolutely zero equity. The phrase, throwing money away on rent, survives because it sounds true. But in year one, Sarah is throwing away $1,950 a month to the bank and the government. David is throwing away $1,700 a month to a landlord. David is throwing away less. Let's fast forward to year 10 because this is where the fantasy meets the spreadsheet. Over the last decade, Sarah's home has appreciated at a standard 4% a year. Her house is now worth around $440,000. She has about $190,000 in home equity. That is real wealth. But there's a catch. Property taxes grow with the assessed value of a home. As her home went up in value, her taxes went up too. And maintenance is not optional. Over 10 years, she had to replace a $7,000 HVAC system, fix a $2,000 plumbing leak, and buy a new refrigerator. That equity is locked inside a building that constantly demands cash. Meanwhile, David has been renting and investing. His original $60,000, compounded at an average 8% return, has grown to over $129,000. His $466 monthly contributions have added another $85,000. By year 10, David's liquid portfolio is sitting at around $214,000. On pure net worth, David is actually winning. If David has a medical emergency, he can click a button and sell shares on a Tuesday. If Sarah has a medical emergency, she can't easily sell 5% of her living room. Her wealth is entirely illiquid. If the video stopped here, the finance bros would be right. Renting and investing crushes buying a home. But here is the part that changes the math more than anything else. The renter's strategy only works if you actually invest the difference every single month. For decades, including the months when the stock market crashes 20% and the news is telling you the economy is collapsing. The data on human psychology is brutal. Most people do not do this. When renters see an extra $500 in their checking account, they don't invest it. They upgrade their car. They take a vacation. They move into a slightly nicer apartment with better amenities. A mortgage, on the other hand, is a forced savings account. Sarah doesn't have a choice. If she doesn't pay her mortgage, she loses her house. She is being forced at gunpoint by the bank to build her own net worth every single month. That forced financial discipline is worth something that no spreadsheet can ever capture. And it is the primary reason why, in the real world, the average homeowner has a net worth 40 times higher than the average renter. But let's look at the end game. Let's fast forward to year 30. David's rent has been increasing by an average of 3% every year. That $1,700 apartment now costs him over $4,000 a month. And it will never stop. As long as David is breathing, he will owe a landlord a massive chunk of his income on the first of the month. Sarah, on the other hand, just made her final mortgage payment. Her monthly housing costs just plummeted. All she owes now is property taxes and insurance, and she owns an asset completely free and clear that is likely worth close to $1 million. In the later years of life, the fixed cost of a mortgage provides a massive shield against inflation that renting simply cannot match. So, what is the honest answer? Buying wins if you are going to stay in the exact same city for at least 7 to 10 years. The transaction costs of buying and selling a home are so high that if you move every 4 years, renting will almost always beat buying. Buying also wins if you know, deep down, that you do not have the strict discipline to invest your extra cash every month. Renting wins if you're in your 20s or early 30s, and your career requires mobility. The ability to pack up and move across the country for a $30,000 raise is a massive financial advantage. Renting also wins if you live in a hyper-expensive market like San Francisco or New York, where the cost to buy a house is 3 times higher than the cost to rent the exact same building. The math depends entirely on your timeline, your location, and your self-discipline. Don't let a real estate agent guilt you into buying, and don't let a stock market guru shame you into renting. Run your own numbers. If this breakdown changed the way you look at housing, hit the like button right now. It tells the algorithm to push this real financial education to more people. Subscribe for more deep dives into the math behind your money, and let me know in the comments. Are you team rent or team buy?